Good day, everybody. My name is Emmett Kilduff, the CEO of the Fortia Group. Let's get started. There's still some people to join, but in the interest of time, we've an action-packed agenda today, so let's crack on. So a few months ago, we surveyed our audience again, asking what topics they wanted us to cover. Red flags in due diligence was one of the top 4 requested for the remainder of the year. So here we are. First of all, before we jump in, I'd like to thank our new sponsors. We have 3 new sponsors, a quality control partner, a legal partner, and a mastermind partner. Unfortunately, Clearco discontinued the sponsorship. They've clearly had strategic discussions over the last few months and had to make some changes. But we will have a new title sponsor as part of our next webinar going forward from next month. But we're delighted to welcome 3 new partners and sponsors. For those that haven't heard of Factored Quality, really good quality control partner led by Prince out of New York, and his colleague Adar, who's ex-Heroes, is speaking today. So please listen to what Adar has to say and think about reaching out to Prince and Adar. I'm delighted to announce our legal partner, Tartakinsky and Drogan. We've done a lot with Mark over the last year and have formally agreed a partnership as of last week. So delighted with that, and welcome Mark. Mark is speaking on the webinar today. And then finally, delighted to welcome the Titan Network as our mastermind partner. I've built a good, quick relationship with Dan out of London, out of Dubai, excuse me, an Englishman out of Dubai, and his colleague is speaking today. So thank you to those 3 firms for sponsoring our webinar series. We started this series in October last year. I think it's fair to say it's one of the best webinar series in the e-commerce space. We put a huge amount of effort into it. And it's great to have partners who will become long-term partners with us, and of course we're seeking more partners as we go on. So today's topic was audience driven. It's what you want us to talk about, as instructed a few months ago. So we went off and got an all-star varied group of individuals to discuss the topic. We have 2 law firms, some buyers, some DD experts. The buyers can be DTC aggregators as well as Amazon aggregators, and we feel it'll give a good flavor for e-commerce entrepreneurs thinking about an exit, as all the things they should think about that might come up in due diligence, and to start thinking about them now. Don't wait till the diligence work streams are underway. Preparation is key, and that's a theme that I think will run throughout today's talks. So the agenda for today, like a lot of our webinars, we've asked the speakers to give inspirational TED-type talks. One of my favorite talks is the TED sessions that you can see online. They're short, punchy talks meant to be inspirational, and so let's see who can really make due diligence really sexy and inspirational today. We will then give a very brief presentation about all the ways one could go about becoming exit ready, which will be a theme throughout the 8 talks. A lot of it's all about preparation. And then we should have at least a half an hour to open up to a panel and audience Q&A. In that regard, please do submit any questions as we go through the webinar via the Q&A button on Zoom. Please do not submit them via the chat button, or they will not get answered. And we look forward to answering your questions as we go through. The final bit I'd say on housekeeping is, like all our previous webinars, the deck will be sent to attendees, as will the recording, and all the recordings are available on our YouTube channel. Just type in the Fortia Group into YouTube. Okay, so let's jump into the 8 talks. They have approximately 5 minutes each. They will be timed. They need to keep to time, and to kick us off, we welcome Carlos Barosi from Goja. Carlos, are you there?
I'm here, Emmett. Can you hear me?
We can hear you loud and clear. Over to you.
Excellent. Thank you. First of all, Emmett and your team, thank you for the invitation. Thank you to all the participants. I think myself and the rest of the panelists will do our best to make due diligence sexy. A tall order, but here's our go. A little bit on Goja before I jump into our presentation. We are an acquirer and operator of Amazon-focused consumer brands. our story started. We started as just like any other seller who might be considering selling their brand, selling other people's stuff. Then we got into the private label game, launching our own brands. In fact, 4 out of our brands are home brewed. 2 of them, are actually significantly material to our financials. And then we got into the M&A game in true Goja fashion with an acquisition of a company called 101 Commerce a few years ago. Some would call one of the original aggregators, and then continued on with the aggregation game. So that's a little bit on Goja. Myself, I lead corporate development and M&A here at Goja, and I'm delighted to be here. So jumping into the presentation first. So just a little bit of a, kind of big picture. Why does this matter, right? Why are we even here today? I think might seem obvious, but I think for those of you who have never exited, it might be interesting to understand why it matters to us buyers. First of all, we have a fiduciary duty to our stakeholders, and our stakeholders include our investors, our creditors, our employees, to understand the risk that a particular transaction presents to the firm on an ongoing basis. And that's a lot, but it's very important. A company, when you acquire, is not just the former company, but it's the pro forma going forward, right? So it's very important for us to understand the risk of a particular transaction. It also is important for us as buyers because it kind of confirms or allows us to update our assumptions that we used before we kind of took a look under the hood, right? Just with some of the kind of like preliminary information that was shared with us as buyers. So it's dotting the T's and dotting the I's and crossing the T's, so to speak. Why is it important as a seller? Interestingly, and we've actually, as part of fundraising, we've actually done this a little bit of ourselves, is when you're going through a due diligence process, it forces you, especially prior to the diligence process, but also during the diligence process, it really forces you to develop an even deeper understanding of your business and what are some of the key drivers and how can you really push on those drivers to improve performance going forward, right? So as a seller, I see diligence as an incredible opportunity, irrespective of what happens with the diligence. Obviously, the ultimate goal is to exit. Otherwise, you wouldn't be in the diligence process. But even if something were to happen where the buyer backs away, or you decide that you want to keep the business and not sell, diligence itself is very, very valuable in that regard. And then finally, if your ultimate goal really is to exit, I think diligence is a true opportunity to develop trust with a buyer. The more transparent and the more cooperative you make the diligence process, the likelier you will be that will happen in developing that trust between you and the buyer. Next slide, please. So I think you'll probably get some more information on this from other speakers and some of the companies supporting this very, very valuable talk. But here are just some kind of big picture things to consider when you're thinking about preparing your business for sale. Your team, the team that you build of advisors is extremely important, especially if this is a first-time transaction. If you've never actually had to exit before, I think you are at a information disadvantage with most buyers, because this is what a lot of buyers do, right? So the number of reps really helps you to be good at anything, including M&A. So to the extent that you can fortify your own perhaps lack of experience doing a lot of transactions with really capable advisors in the form of accountants, lawyers, and financial advisors, that's absolutely critical. And on the law side, I would just say, if you think about what game we're in, we're really in the intellectual property game here, which is why I'm glad we have some experts talking on that issue today. So, it's not only having a lawyer or an attorney who's experienced in doing transactions, it's also a lawyer who can help you determine how well protected the assets that you are acquiring really are, right? And especially in the form of IP. So absolutely critical. Something else I do suggest to sellers as you're thinking about an exit is try to think as like an investor, right? Put yourself on the other side. Always invert, as they like to say, right? So what I would do if I were exiting my company is I would really take a look. I'd go down the P&L and the balance sheet line by line and say, okay, revenue, break that down into, units, average price. Something we've discovered, especially right after COVID, was that a lot of performance was not necessarily indicative of the earnings power of the company going forward, because there were obviously very specific situations during COVID that either really hurt a company or really benefited a company, right? So to the extent that you can kind of think of each line item on your P&L and your balance sheet and say, okay, if I break this down on the last 12 months, did I sell at a much higher price than I would have normally because of, a COVID bump, so to speak? And the reason you want to do this is not because you necessarily want to become a financial analyst, but a really good buyer is going to do that themselves, and they're going to be preparing questions based on that kind of line by line analysis of your financial statement. So to the extent that you can do it and be prepared with really good answers, then that's really value added. And that's related to this last topic here of anticipate areas of concern, right? Going through your P&L, going through your balance sheet, going through your financial performance can actually help you do that. So you can develop, first of all, you might discover some things that maybe you didn't know. And second of all, for the things that you do know, it can give you the time to really think about it. How do you answer some of those tough questions that you're going to get in diligence? Next slide, please. Typical pitfalls: lack of preparation. Time kills deals. Make sure to do a lot of work even before you launch a sales process. And getting that team in place early on can really help you do that. Again, think like a buyer. If you can do that, then you can kind of anticipate some of the things that buyer might be looking for. And just kind of like last little piece here on some of the things that we've seen in diligence process that have actually hurt our chances of getting a deal done. One thing is underreporting duties in the form of misclassification of the category, underreporting container value. These are things that like an institutional buyer can't afford to do on an ongoing basis. So make sure that you're cleaning that up. And then just, in the case of Goja, we're very Amazon focused. Just make sure that, you're operating in a way that is consistent with Amazon's terms and conditions. To the extent that you haven't, that could really put a deal at risk. Next. And then finally, what to look for in a potential acquirer. Having someone with a buyer with M&A experience that's done similar deals is critical because they kind of already know what to look for, and that can speed up the process and also give you a higher degree of certainty that it's going to close. Being organized, right? Detailed due diligence checklist and timeline. Are they well capitalized? Can they close on what they're saying they're going to do in the term sheet? And finally, just character. Is this someone who you would engage with on, kind of, would you choose to spend time with this person, have a beer? I know that that's a little bit of like a softer, less quantitative, more of a qualitative quality, but nonetheless equally important. And that is my talk for today. Thank you very much.
Great. Thank you, Carlos. Thank you for kicking us off, and look forward to Carlos answering any questions that you, the audience, have. Please do submit those via the Q&A button as we go through today's discussions and talks. Okay, next up, please, we have Simon Tini from eComplete and Conjura. Simon, are you there?
Hi, Emmett. How are you? All good here. Can you hear me?
I can hear you. I can't see you yet, but I can hear you loud and clear.
Very good. So you should be able to see me now. So just 30 seconds on eComplete and Conjura. Conjura is an analytics business that was set up to support brands and service providers to brands online, direct consumer e-commerce brands. eComplete, Conjura spun out a lender called Wayflyer, which lends to thousands of brands. Merchant cash advance provided to thousands of brands based upon downloading data. And then eComplete was also founded to acquire direct consumer e-commerce brands. And in addition to giving capital to direct consumer e-commerce brands, eComplete also has a bench of talent which it uses to support its brands across 3 domains: infrastructure and better provision of services and at lower prices, marketing, centralized marketing, and also internationalization expertise, and in particular Asian expansion, internationalization expertise. So just to the first slide then, if that's okay. Great. So I'm looking at this from a lens of e-commerce businesses, often both buy side and sell side. But very first thing, what to expect if you're selling your business: to provide full access to data. Don't waste your time thinking that you may not have to do it. Today's buyer will want access to all your APIs for your e-commerce infrastructure, Google Analytics, your shop store, Shopify, WooCommerce, BigCommerce, Magento, whatever. Ideally, it's not an in-house build, because I don't understand, we often don't understand why people will try to compete against Shopify, for example. They want access to your ERP, that might be Brightpearl or Sin 7 or NetSuite, for example. They will definitely want access to your marketing software, from your affiliate partner like WebGains to your paid ads, paid social, and so on. And then it may also look for access to your product data in your warehouse and the couriers you use. I wouldn't delay in testing your capacity to provide data at all. We get very frustrated both as an investor and also a provider of diligence to buy side and sell side, where folks think that they have an in-house BI team that can provide access to data instantly, and in many cases they cannot. So I'd really encourage folks to do a mock data access process, see how quick you can get it done. It should take half an hour or maybe a day at most, but in many cases we see diligence dragging on from when it should take a week, maybe 2 weeks at best. It can often go to 3, 4, 5, 6 weeks because people don't have their data in good shape. So don't delay in access provision. Your data, everybody you come across in e-commerce says, "I've got my data's in great shape." It often isn't. I've never seen an engineer change job and walk into a new business and say, "This code is fantastic, I can use it." Most people want to redo it every time. So we're a big believers of hiring folks to do that for you. Custom-made software is a nightmare. In-house solutions will always delay the main aggregators or the larger brand operators' processes. So beware that in-house builds. And most advisors and all professional investors expect access, process exclusivity, and often if you want to add velocity to the process, and echoing what Carlos just said, time is a killer, perhaps even pre-exclusivity under a strict NDA. Most of these investors will often have their own APIs that will download your data in minutes or seconds and minutes, and they may even build a new valuation model from the ground up. And that's what we're seeing happen more and more. The months before you raise, ensure to put in place an automated data solution. It's a no-brainer that updates your valuation model daily. I personally would recommend you avoid any key person risk in your BI team, your analytics team. And also just in terms of data access, just be aware of your seasonality. Try not to come to market during your down periods, come to market during your growth periods, and but have it well modeled out so people can understand it. This next slide, please. And in 2023, and currently in 2022, it's possible in 2023 it's going to become the norm. You need to benchmark your business. So what I mean by that is benchmark, like the world of e-commerce has been traditionally an absolute game, as in I understand my own absolute numbers, but I don't have a clue about my competitor and what their numbers look like. It's often, was previously anecdotal. Great advisors like Emma Kilduff will give you a great steer on EBITDA margins and gross margins. But in the coming months and currently and in the coming months and years, you will be able to benchmark yourself against a peer group or against the market for AOV, most definitely revenue, where you rank either top decile in revenue growth, new versus existing customer rate, repeat order rate, channel performance, conversion performance, and traffic performance. All of these things can be benchmarked against the market. And in particular, which is going to become really interesting, is at the end of 2022 into 2023, you'll be able to benchmark your metrics against a peer group of companies that are in your category, at your AOV size, in your geography. And you should be very proud if you have great metrics that you're going to be beating an awful lot of your competitors, and you should be slightly concerned if your metrics aren't up to scratch and your benchmarks don't look good, because it will become the norm for investors to benchmark you against others in your peer group. The best advisors have many benchmarks to study from publicly quoted brands and larger privately held ones. But there are a host of e-commerce benchmark tools now available, and be proud to share when your performance is in the top decile. Sorry, next slide, if that's okay. So in 2023, e-commerce is going to be more and more sold on EBITDA, with a focus on profitability growth and how scalable your business is. I would really encourage you in the time before you kick off a sale process to ensure that you're looking to tighten your margin with all of your suppliers and improving service options at the same time. So every brand that we see and I see are leaving, well, a minimum 3% and also sometimes as much as 7% of EBITDA margin on the table by not finding ways to improve their pricing from common service providers to e-commerce businesses. What I mean by services, I mean freight, I mean customs clearance, I mean payment gateways, fulfillment, and in particular your couriers, the price of transporting the goods from your warehouse to the front door of your customer. I really encourage you not to leave cash on the table for the buyer simply by being, and lazy is probably too harsh a word, but maybe haven't looked around enough to improve your margin through finding aggregation partners that do exist. Before you sell your business, they like to aggregate scale for putting many businesses together into a common buying process, and it does achieve much better pricing across those elements. Just the next slide, and I'll try and rapidly finish up here. Fix your metrics very quickly. Revenue growth is critical. Many brands use MCAs to add velocity to growth that lead up to any sale. Once again, being aware of your revenue relative to peers is critical. AOV every single day in the days and weeks leading up to your sale. Try and increase your AOV. Growing your AOV will improve your valuation, will improve the value of your business. GP, know your GP versus your benchmarks. Skincare, for example, in Europe, if you're not at 70%, you're going to struggle against the larger brands. Cost of sale, if you're spending more than 10% on marketing, you're going to struggle. And just the final, second last slide, I guess. We can see the next slide. CAC, very healthy diversification of channel mix, absolutely critical for e-commerce businesses. If you're relying on paid social solely to grow your business, you've got a few issues to solve. So start testing. Repeat order rate has to be above 30%, and then lastly, EBITDA margin. You need to be competing with the brands that are doing between 20 and 40%. So just last slide in the summary. Be prepared to give full access to your data. If you can't provide your data in minutes, hire a software provider that can at a fraction of the cost. Benchmark your business in advance across as many common metrics. Coming to market blind against your peers will only lead to an unsatisfactory outcome. Fix your service pricing every day between now and the launch of your process. There are both service improvements and savings to be made, which will help defray the costs of inflation and then shocks. And then lastly, know your e-commerce metrics and try to improve them every day. That's it. Apologies for running over.
Thank you, Simon. Lots of great detail there. And again, if you have questions for Simon, please submit them. There's lots of questions coming in, and our speakers are already typing their answers to those questions, and we'll discuss them live later on. Okay, thank you, Simon. Let's move to Nate Ginsburg, who recently acquired Centurica. Nate, over to you, please.
Hello, thank you. My name is Nate Ginsburg. My quick relevant backstory was a e-commerce and Amazon seller, started in maybe 2014 or 15, sold that business in 2017, kept my team and started offering services to other Amazon and e-commerce sellers, which became now my other agency, Sellerplex, which is a team of around 70 providing services to e-com and FBA sellers. And then earlier this year, I acquired Centurica, and Centurica is the premium buy-side due diligence service provider for online acquisitions. And we work on a lot of e-commerce and FBA businesses, both for individual buyers as well as aggregators or anyone doing a roll-up. And so the perspective that, that I'm bringing here is really insights from the buy side. And, we do a lot of reports on, again, e-commerce and FBA businesses. And these are red flags that we tell our buyers to watch out for. And so on the sell side, these are things that you should be aware of that, again, your buyers are going to be looking at so that you can better prepare and hopefully avoid them. So let's go to the first slide, please. All right, so the first is a big one on for Amazon. And so this is review risk. This is a, the whole Amazon review game has been changing a lot over the years and is incredibly important to the success of the products and the business that you acquire. And so you need to make sure that the reviews are legit. And so some of the things that that we do when reviewing an Amazon business is, we're gonna run first we'll do some manual checks, which you can do as well by sort of just scanning listings, or you can be aware of if there are a lot of listings of like, in exchange for an honest review, that could be a potential red flag. As well as we are going to, just monitor. We have a whole database of different, giveaway promotion platforms that we're going to look at. And, and I know that the review stuff, a lot of it's gray, and it doesn't necessarily mean that a buyer is not going to be interested if you've done some promotions. But know that, I mean, as a diligence provider, this is an area that we're looking at and advising our clients on. And so, you should at the very least, be transparent and communicate. And also, in general, don't do anything shady that could lead to your account getting banned or your products getting taken down. So, so reviews. Next. It's a quick thing. So, things that we look at to spot is, like I said, manually looking at PayPal statements for, if there's tons of refunds for $11.98 going out, Facebook ads, if you're talking about giveaways, as well as looking at other platforms to, identify these things. So things to, again, be aware of that, diligence and the buyers are going to be checking. Next slide. All right, so the next one is a big one, and one of the areas that we see the biggest discrepancies. And so part of our due diligence, or a core part of our due diligence, is rebuilding the P&L from scratch, including the COGS. And so this is one of the areas that there is going to be, that again, most commonly we see deltas and discrepancies in versus what the seller is providing and what rebuild that goes to the buyer. And so, this is an area that, really you just want to do cost of goods right. And a lot of people aren't. And even ones that think they're doing it right, a lot of times aren't. I mean, honestly, cost of goods, it's very tricky. And so really on this, you just want to make sure that you're on top of it 100%, because if you're doing it wrong, I mean, it's likely not gonna kill the deal, but this is something that later, after diligence, after the P&L is rebuilt, if the buyer finds out that, they redo their calculations and cost of goods is, 10% higher, then that's going to get, that could very well affect a adjusted offer that they're going to give to you. And so, and some common things that we see that sellers do incorrectly is doing their COGS in cash versus accrual, using fake supplier invoices to avoid paying tariffs. Another thing also is just being aware of very volatile freight rates. And so, our buyers and part of our process is going to be we could rebuild COGS with an average of the last 3 months of freight rates if freights have been going up. And if you were doing it from an average of the last 12 months and then it's lower, again, just kind of being aware of ways that buyers are thinking about cost of goods as a part of the P&L rebuild, so that you can, be aware and be in front of that, and ideally do it as accurate as possible. So there are less deltas and less renegotiation after the rebuild. So next slide. Next is so compliance risk. And, this is a big one as well for Amazon, as well as in general. And I think that the general trend is, platforms are becoming more, more discerning. A lot of these things, it used to be the Wild West. You could throw up and sell anything anywhere and it was fine. And, but yeah, as the market in, e-commerce generally matures, the marketplaces are becoming more stringent. And so, really just as a seller, make sure you're in front of all your compliance, have the relevant certifications, everything checks out, because this is something that, could be a big red flag. If you don't go through the right process to make sure your products are all compliant, beforehand, it can cause problems when you're trying to sell and the buyer identifies some things. So next slide. So another one, and this is another big one that we see and is very important to buyers and potentially can kill deals. And so really, so one of the factors that we look at is really margins over time. And so taking a look at your product price over time, associated fees, platform fees, advertising spend fees, and looking at the what that trend line looks like. And so something to just really be aware of is staying on top of your margins, making sure they're healthy, and doing what you can so they're not decreasing, because again, that's really important to buyers and what they're going to look at. Next slide. Next slide, just showing an example, fees going up. Next slide, I'm running out of time, but more on margin. Yeah, PPC, an ad spend risk, this is for Amazon, for, ones that are doing D2C social ads. But yeah, we're looking at the, ad spend over time, cost of acquisition over time. And, you want to have a positive trend and not show that costs are going up, margins are going down, because that's really big for buyers. Next. Sales trend risk. I think this is the last point, is, buyers, we advise our buyers, and it's really important to be aware of, not just the overall sales trends and overall profit margins, but, looking at things on a per SKU basis. And so, our financial diligence, we break out everything on a per SKU level to look at trends. And so yeah, stuff to be aware of as the seller to, look at your portfolio, however many products you're selling, and you want to look at them all from an individual basis, which, can be a little bit of a pain, but it can really give you clarity. And so you can, cut any losers or anything that isn't, as profitable or could be bringing your overall product portfolio or brand down, that again, buyers are looking for. Next slide. That might be it. All right. Thanks, everyone.
Thank you very much, Nate. Appreciate that. And again, please keep the questions coming for Nate and other speakers as we go through. Okay, so let's keep going. In the interest of time, we have Adar Granot, who's from Factored Quality, Head of Core Business Operations. And thank you, Adar, to you and Prince for being a partner and sponsor of the webinar series. Over to you, please.
Of course. You can hear me well, right?
Loud and clear.
Amazing. For first summit, Matthew, thank you for inviting me and for the warm intro. I think this is a super interesting and important topic. Quickly about us, Factored Quality is a tech-enabled service company. Our mission is to build the best quality control, compliance, and testing platform in the world. We help consumer good brands of all sizes run quality control on their suppliers, products, and inventory anywhere in the world for any product in the world. Myself, I lead global ops and expansion activities at Factored. Today, I will bring the buyer perspective as well as the third party helping aggregators to audit brands, but also for brands that help prepare for a potential sale. Just as a heads up, I'm going to share over the next couple of minutes a couple of examples and concepts I've identified while working at Heroes and Factored Quality, looking at hundreds of stores and sitting on tens of due diligence evaluations, focusing primarily on supply chain due diligence. Now, the key concept I want to focus on today, and I believe you need to understand as a seller, but also as a buyer, is risk. More specifically, how do I reduce risks? Sellers, what you need to understand that as buyers, I don't have the same knowledge about the business that you as sellers have. That's why I'm taking measures to minimize this risk. Now comes your role as a seller. how do I help buyers minimize that risk? In supply chain specifically, the main risks I'm trying to mitigate as a buyer is first visibility and accuracy of the inventory. Am I paying and am I getting the right inventory? Second is the product and supplier quality. So this means, does the supplier, carrier, warehouse operate in a reliable way, provide good service and high quality, and can they scale with me? And following up on what Nate mentioned earlier, compliance. Some products, food, supplements, medical devices, toys, electronics, and there are many more, require a certificate / a lab test showing that that product can be sold in regions where they are sold. So basically what I'm asking myself, are there legal liabilities I'm taking on when I acquire a certain brand? Can this product even be sold in a different region? If we can move to the next slide. Now, some of the downstream effects, aggregators, roll-ups, the M&A process is just the first step. They also think about integrations and the day-to-day management post-acquisition. Now, the points I mentioned earlier, first, delays in production, right? Inventory, supplier, quality, compliance. Second is the inventory, which you know better, influences your ratings and your sales. And the third is a potential lower exit price. Now you ask yourself why. You have to keep in mind the macroeconomic conditions we're in. So money is not cheap. Investors are obviously looking to make money, not lose it. And how do they do it? They take lower risks. Now, if I foresee a store brand to have a lot of issues and risks associated with it, I will ask for a risk premium, meaning the multiple on your business will be lower. If we go to the next slide, a couple of examples from heroes. If we can go one slide up, next. Okay, so thanks. A couple of examples from heroes. As I said before, I sat on tens of due diligence evaluations, reviewed even more before they came to a full evaluation. If I have to summarize the biggest red flags from a supply chain perspective in due diligence, I would say first is inventory, not knowing the actual amount and location. Second is the supplier performance. This refers more to defect rate per supplier, per product, inventory handling performance in different warehouses, as Simon mentioned earlier, but also social compliance of suppliers, working conditions and supplier certificates. But the most problematic one, and I really want to emphasize this one, is product compliance. I cannot stress it enough. Now, what are the results that I've seen? Well, the worst one was just a no sell, especially due to products compliance and quality. As this is about avoiding risks, right? Second one was lower valuations. As I mentioned before, this is about forecasting risks and just a longer due diligence. This is like reducing risk. If we go to the next slide, at Factored Quality, we've been helping hundreds of brands and more than 10 aggregators. Just that you understand some of the work that we've been doing inventory counts, so identifying the quantity of the inventory in different locations. We've been doing inventory audits, understanding the quality of inventory in different countries, different 3PL warehouses. We've been doing supplier audits, understanding the quality of certain suppliers, and obviously product testing. So making sure the product performs according to certain expectations, but also is compliant for sales in different countries. Next slide. I'll summarize my beliefs and recommendations in this slide. I think you guys know it better than I do. It's how building a good business. It's equally as how to sell one. The first point is invest in good supply chain partners upfront. Audit them, build long-term relationships, invest in quality insurance. I want to make it clear, auditing partners is not a sign of bad faith. It's a sign of being a professional. Second one is routinely run quality control, inventory audits, inline inspection, pre-shipment inspections. Don't wait for your customers to give you insights for low rankings and high return rates that your products are of low quality. By the time you figure it out, I can guarantee you it's going to cost you 20, 30x to solve it. So the concept here is solve problems before they escalate. The third one is invest in systems and platforms that help you run the service, but also create a system of record, right? Being a professional with your operations is the first sign of a solid business, whether it be it financials, shipments, or quality control processes, and make sure they're all integrated. At the end, everything I just mentioned is there to help you run, grow, and yes, also sell your business. I will finish by wishing everyone out there today good luck, whether you're buying or selling businesses. It's a challenging path. If you guys have any questions, I would love to chat in the Q&A. Feel free to connect directly on LinkedIn/email. And that's it. Emmett, I'll pass the mic back to you.
Thank you, Adar. And we at the Fortia Group had a deal last year where the buyer did a factory audit out in China, and it scored 3.2 out of 10, and it killed the deal. It postponed the whole process. So I think the factory guys here have produced a really good solution, and for both buyers and sellers. And we're encouraging all our sellers to do some of these inspections in advance of going to market to show that, you know, they're looking to be really transparent and whiter than white. So thank you. Right, let's move to the next speaker. Welcome Thomas Jessup, please, from Moonshot. Are you there, Thomas?
I am, Emmett. Thank you very much, and good afternoon, everybody. Thomas Jessup from Moonshot Brands. So Moonshot, we're an international acquirer of brands that have a presence on Amazon, but also in other sales channels as well. We have operations in the US and in Europe, as well as China, actually. And we look to acquire brands from around the world. So let me share a few insights with you, Moonshot insights from our process, and also our mindset when it comes to due diligence and the kind of red flags that we would typically see when we're acquiring brands. So if we could go to the first slide, please. So there are a few kind of key points that I'd like you to take away today. So from our perspective, don't be worried about due diligence. In essence, we're just looking to confirm things that we've already been told. We're not looking to catch anyone out in this process. Like, so for instance, in the same way that you would buy a car, you know, you'd verify the spec that you expect to receive. So 4 wheels, leather seats, blue paint, etc. In our case, it's just a little different. So, you know, this is the revenue you mentioned, this is the margins, this is the amount of inventory, this is your team, your operational setup. So we're just looking to confirm what we've already been told and what we're expecting to see. The next point is that we're professional buyers, and we pretty much do all of the heavy lifting. So I review, you know, on behalf of Moonshot, hundreds of companies each month. We know everything about Amazon businesses, and we know exactly what we want to see. And the process is very structured. So we'll give lists and requests, you know, in relation to what we need to see. And it's a very, very simple, straightforward process on behalf of the seller. We're also set up to move very fast and to make this process easy and collaborative, as I said. So we've got all sorts of automated tools and processes that we've used over tens of deals now, and it makes it very, very simple. So from an LOI through to a transaction closing, this can all happen in as quick as 30 to 45 days in our case. And there's one additional point as well, which I'll come to later at the end when I talk about some of the, you know, examples of red flags, which is it's great to be prepared for this process if you can be, but at the same time, never put anything in the way of operating your business as well as you possibly can. I'll come back to that point. Okay, if we go to the next slide, please. So I'm breaking this down into 2 stages. So firstly, this is kind of pre-LOI. So this is when the diligence process actually starts for us. And stage 1 is diligence that we do before we even speak to you. So we learn a little bit about your brand, and immediately we start analyzing your product and your, you know, the brand itself, the positioning of that within the category and the overall market. We're looking at trends in your BSR and in your pricing over time, and, you know, what your in-stock position has been historically. We begin building out the market and sizing that market and thinking about what the future trajectory of it is. And we begin also, you know, a high-level review of your financials and comparing that to other companies that we've seen within similar categories, you know, within the same category or adjacent categories. The second stage, if we see something that we like there, is to get a bit more detail. And this is when we initiate the first seller call. And there are a few points to this. So the first is that we want to get a view of you, the seller. So we're looking for someone who knows their business well. A well-informed, thoughtful seller tends to run a good business, and therefore we get higher confidence in the transaction overall, especially that things are as they are being represented to us. When we enter into an LOI with a company, you know, it's a very serious endeavor for us, and it triggers a deeper process on our side, which takes a lot of time and money. So we don't do this idly. On that call, we'll take the opportunity to maybe touch on a few areas that we want to get a bit more detail. So like, who are your suppliers and where are they located? And do you have good relationships with them? What is your fulfillment strategy? Are you direct to FBA? Are you using, you know, a 3PL feeder strategy? Do you have your own warehouse? We might ask some questions about your current inventory that you're holding across your supply chain, and things like, you know, what is the team, their positions, and are they going to stay with the business post-transaction? We can also ask a few questions about your financials, especially anything that is what we might consider an outlier. Like, okay, looking at this, this margin is a little bit low, it's a little bit high, and just looking for some contextual color there, by building a thesis and an understanding of the business. We might touch on a few other things as well, like regulatory and legal, and start getting a sense of what the growth levers might be in the business. So are there any additional products in the development pipeline? And, is this something that you've considered taking to international markets, and have any steps been taken in that direction? So that's pre-LOI. If we like everything we see there, then we issue an LOI, and that has a kind of summary of transaction terms, and then hopefully we sign that together and we go into an exclusivity phase. And that's when you'd be introduced to our due diligence team. And I would break this down into kind of two stages. Sorry, can you go to the next slide? So the first stage post LOI is what I would call as information gathering. So this is, again, really simple, and it's led by us. So we'll give you data requests, essentially. So we might start off, for instance, with just a list of assets. So tell us, specifically what IP you have, any trademarks, any patents, any links to your storefronts, so Amazon, Shopify, Walmart. What are your social media accounts? Like, give us your supplier and insurance contracts and your warehouse contracts and a list of your inventory. Very, very simple things that we need to, again, be used to confirm what we've already seen in the summary data that we've received. We'll also start to rebuild your P&L, so your financial position in the company. And for that, we'll need access to your marketplaces. So for instance, seller central permissions, so we can go in there and extract the data that we need, again, led by us, which reduces the burden on the seller. And historic P&Ls and bank statements and other kind of cost inputs to your P&L. So things like supplier and freight invoices and employee contracts and warehouse leases and things like that. Again, all very simple, straightforward things. And once we have that, we will do an assessment on our side. And it kind of breaks down into sort of two areas of financial assessment. The first is something called proof of cash, which is where we're just looking at, basically money moving through your bank account and matching that to revenue expectations and kind of cost expectations, just to make sure that there's the right amount of money moving through the company. The next thing is called quality of earnings. So that's where we rebuild your P&L, and that's to verify its accuracy. So again, we've received, potentially some information from you. We just want to confirm that it is as we expect. And then again, we'll start kind of building out more our thesis of why we want to buy this company and what we expect to do with it after we acquire it. So if we can move to the next slide, please. Typical red flags that we see. The first one is where a seller drip feeds or hides information from us. So let me give you an example. This is two real examples. So company A came to us and they had a very, very material legal issue, but they were entirely open about it. And they shared all the information with us, including their view and supporting documents. We did our own review and we agreed with them, and the transaction proceeded as planned. Company B came to us and they had a very immaterial legal issue, but they hid it and they only drip fed information to us when they were prompted. And this damaged trust and it created more work. And we always wondered, are there more things that we're not aware of? So that ended up hurting their economic interest. Like, the deal went ahead, but we had to put in place a larger holdback on the transaction to adjust for that disclosure of this. Other things are, these have been covered. So black hat tactics, fake reviews. We have natural language processing software, so we'll always detect fake reviews, and I can talk about that more, how that works. Things like multiple accounts are a red flag to us. Other things are the seller is the factory. This happens sometimes. So you find out that the seller is not just the brand, but they own the manufacturing as well. So that needs to be thought about, because the margin is about to take a hit due to kind of recontracting with the factory if it's on a sweetheart deal terms. The factory, there's relaunch risk, they could replicate the product, that sort of thing. If the brand has no inventory or very heavily aged inventory, that's a problem. The business obviously can't operate without inventory after the transaction, and aged inventory isn't necessarily saleable. And then reselling. Reselling is a no-no for us. We're only looking for private label brands. So we either need to kill the deal or those ASINs would be carved out. But if I just make my final point, which is, as I said at the start, like, it's great to be prepared for due diligence, but ultimately we want to buy the best businesses. So if you're working with someone who can help you do that, that's fantastic. But ultimately we're looking for great companies and I'd always choose a company that's well operated over well prepared. And this actually happened to us. So we bought one company which didn't even have any financials prepared, versus another which came to the process incredibly well prepared, but the business was declining over time. So make sure you work with the right partners, but at the same time, just concentrate on building a really good business. Thank you.
Thank you, Thomas. It was good to see that your comments split into the different stages of a deal. That was helpful. Thank you. Great. We'll now move to the first of two lawyers. I welcome Nathan Lapsley from 458 Law to the floor. Are you there, Nathan?
Yeah. Hi all. Really pleased to be joining the discussion today. My name is Nathan Lapsley and I'm a corporate lawyer at 458 Law. At 458, we largely focus on supporting e-com operators and investors with all of their strategic transactions. Appreciate that diligence is quite a dry topic, so I'm going to try and make it even more boring by talking to you guys about legal diligence. Next slide, please, Emma. So legal diligence in this place typically covers the areas that I've itemized in the top half of the slide. The focus for buyers and their counsel tend to be on those areas that are in bold and italicized. So the areas of diligence are pretty set. What will change is the scope of diligence. And in this space, scope typically depends on several factors, but I've picked out a few that are probably the most important. So number one, so deal structure. So if we're doing an asset purchase or a share purchase, so there's often more sensitivity around acquiring a legal entity, which can lead to the scope of diligence on a share purchase being more extensive relative to an asset purchase. But within structure though, structure also includes pricing terms because that's also a big factor. So if we've got more upfront dollars, that also leads to having a broader scope for diligence. Point two, international presence. If the target business operates in multiple markets, then that's multiple laws and regulations that an operator will need to comply with. Simple math tells you that often means more things to diligence for a buyer and buyer's counsel. Number three, sort of a buyer's attitude to risk will also play a big role in the scope of diligence. We're seeing more scrutiny from ICs at buyers and ICs at debt providers. And acquirers are naturally more sensitive around where they allocate their capital. So we're seeing this is leading to a broader scope of diligence on deals. Next slide, please, Emma. So what are we seeing kill deals in 2022? So reg breaches. So by far and away, the number one reason deals are falling over are regulatory breaches. Sellers need to come into the process recognizing that regulated products need to be compliant with the laws in each of the territories those products are being sold. Let's take health and wellness brands, for example. So you guys make sure the levels of ingredients are compliant and that the claims in the listing particulars and the labeling aren't too aggressive. Buyers' counsel are always going to take a cautious approach on these things. Number two, sort of complex corporate structures. This year we're starting to see sellers with more exotic corporate structures than the more typical single trading company or trading company holding structure. This planning's not necessarily wrong, but it can make an asset less desirable, particularly where the seller has a preference for a share sale. So if you're going to have a more exotic structure for this space, I'd say just make sure you have the EBITDA and the cash flow to justify it. Number three, so a frustrating one for Amazon sellers is non-compliant barcodes. So we're seeing some buyers take real issue with Amazon sellers that haven't acquired their UPCs directly from GS1. To the extent it's killed a few deals this year. So there seems to be a real sensitivity around the risk of suspensions for non-compliant codes. And this becomes more of an issue where we've had sellers with sort of one or two hero SKUs with non-compliant codes, and those SKUs represent the vast majority of its EBITDA. Number four, so lots of small stacks. So I think sellers need to appreciate we're currently in a buyer's market. you know, there's lots of great brands available for sale, and there's less competition for assets amongst acquirers. So, you know, no reasonable buyer is going to be expecting a brand to be gold plated at closing. But at the same time, you know, they don't want to inherit lots of problems, particularly when there's lots of opportunity to allocate capital to other assets. So next slide, please, Emma. So what can sellers do to ready themselves for the diligence process? So yeah, common theme running through this discussion is preparation is key. And one of the tools and levers that sellers have is vendor diligence. So sort of right at the start of the exit process, you know, if you're a seller, start to have a think about the areas of diligence that a buyer is likely to inquire about. And if there's any snags, fix them before you even start courting with acquirers. Another key tool is composing the right deal team, you know, the right experienced deal team. So, you know, diligence is a time-consuming process. You know, it eats sellers up. I've seen it both physically and mentally. And the last thing that a seller wants is for the diligence process to impact brand performance during the sale process. So create a team. So if you've got internal resources that you can lean on, then do that. But importantly as well, you know, engage the right external team across M&A advisors, experienced lawyers, accountants, you know, professionals that can really add value and help you to respond to inquiries quickly and accurately, because, you know, time kills deals. And it's sort of dovetailing with two is comms. So, you know, once you've got your A team together, it's then about frequent comms between buyers deal team, sellers and sellers deal team. You know, if issues come about, then try and speak about them and fix them sort of openly and quickly. You know, don't let issues stew, because they just start to compound and people end up getting sidetracked and end up thinking they're worse than what they are. So overall, from a legal perspective, and I guess just from a transaction perspective altogether, is you know, keep momentum in the deal. You know, try not to let the deal get sidetracked by issues that can be fixed before the sale process gets going. So yeah, that's it from me.
Thank you, Nathan. Appreciate that. Okay, we have two more speakers and then we'll open up to discussion. So I'd like to welcome Matt Fips from Titan Network to the floor. Matt, over to you.
Hi, Emmett. Hi, everyone. Great to be here and chatting to you all today. My name's Matt Fips. I work for the Titan Network. Quick pitch about that. It's an advanced seller mastermind community where our members can share the latest strategies with each other. These are terms of service compliance strategies, repeatable, scalable frameworks, which give them aggressive growth on Amazon, and that's our main goal. We underpin this with our own proprietary tool suite, which is heavily focused around Amazon as the principal marketplace. Personally, I left the Air Force a few years ago after 21 years, and towards the end of that, I moved into e-commerce with my lovely wife, and we built a brand and exited it after 3 years in a multi-seven-figure deal. And have since moved on to our second brand and just got that up to 7 figures in our first 18 months there. So it's been a real roller coaster for us, and we've been in Titan all that time as well. I became a leader in Titan a couple of years ago, and I now head our top level mastermind inside the group, where we bring all of this together that I've just mentioned to help sellers accelerate their growth and get themselves a nice high 7-figure exit. Okay, let's move on to the next slide, please. Okay, so for me, I mean, we've heard lots today from lawyers and various buyers and agencies that are going to help you. Today, I'll talk to you from the seller's point of view, which is where we're very much focused. So anywhere from 12 to 20 months before reaching due diligence is where we're thinking. And really what we're about here, about taking this dry subject of due diligence, it is super important for our sellers. We really do have to make sure that when we realize we've got something going with our business, something good that can be sellable in the future, We need to really make sure it's running like a proper business, not something that we just started up in our basement or wherever. So as sellers, especially Amazon sellers, there's a lot of corner cutting that goes on, a lot we don't understand when we first get going. All of that needs to catch up in the 1 to 2 years before you exit, so that you're fully up to speed in these different areas you see here before your exit. Next slide, please. So just raising some of the red flags that from my experience and experience of members in the network that we've seen from sellers. Really, one of the biggest ones is financials. Having an accurate cost of goods. It came up as a question today, really understanding how much you paid for your goods, charting that in a simple Excel spreadsheet or dropping it into a tool. You can monitor that, and that's really going to give you an idea of profitability. Inside Titan, we focus heavily on profitability and really getting people's business fit with, PPC structures and frameworks that are going to help them to become profitable, reducing that advertising cost of sale and building that profit up. We recently had a member join us. They'd gone to exit. They got to LOI, just before LOI, and it was realized that their business was negative 15% profit, which obviously wasn't going to be sellable. But that seller didn't even realize that they were losing 15% each month. So it's a really important thing to do to make sure you focus on that profitability. And we work hard in Titan to track that with our tools all the time, even on a daily or weekly basis. Business liability insurance, yeah, so as we're focused on Amazon, this was introduced in the last year. Sellers of $10,000 or more revenue a month must have business liability insurance. There's no way to really circumvent that now, but equally, you've got to make sure that your insurance covers the correct products that you sell. So if you're selling knives or weapons or even toys and games, the cost is going to be a little bit higher because there's an increased risk to your customer. So just make sure you have the right level of insurance for the amount you're selling, as well as you're covering current products and aware of future products, just to make sure that's all in order. On the legal and IP side, you need to make sure all of your trademarks are there. Any patents you've got are live. Some sellers have gone through to LOI and it's found out that they didn't own the patent. It was actually the factory that owns it, for example, or they submitted a patent, assumed they got it, but hadn't. One big one we see quite often in the network is the Chinese trademark. Now, we encourage all of our sellers, as soon as they get a successful business, to file a trademark in their country of manufacture. For many of us, this is in China. What we've seen recently is Chinese bad actors registering our members' trademarks in China and then blocking the export of those goods from that country to the US or wherever they're selling in the world, effectively rendering them ineffective. And that actually happened to someone during their due diligence, which pretty much axed the whole deal because their supply chain was completely broken by that. Okay, next slide, please. Compliance, yeah, it's been mentioned a few times tonight and with great reason. This is a really important one. Again, a lot of people wonder about designing their packaging, getting it right, but they don't put the right amount of thought into compliance and what is actually required by the country they're selling in. So for example, if you're selling in the US, the Product Safety Commission, the Children's Product Safety Commission have a robot you can just run your product details into, and that will tell you exactly what you need to put on your listing. So things like your supplier address, choking hazards, et cetera, and that's really got to be on there in order for your packaging to become compliant. I had another seller who came to join us. Again, they got as far as due diligence when the buyer realized that they were selling goods that start fires and they didn't have any warning on the package that this would be the case. So a lot of backpedaling there required to work out if that inventory is then sellable or what changes or risks can be managed, et cetera. So really take a step back and get a consult if you need to and find out what your compliance requirements are. Account health, ensure seller account is healthy. Avoid any black hat tactics. This is becoming more and more phased out, certainly on Amazon. You need to learn the clean ways to scale your business. So if, for example, if any of you on the call are Amazon sellers, it's no longer okay to give away products in exchange for rebates. Obviously, you can't incentivize reviews as well. This sort of activity is a huge red flag for due diligence because it puts that account at risk of closure even after you've sold it. Amazon could find out if they find a group of bad actors and close that down. And then the last one was HS code accuracy. This is difficult kind of legal language, but it can be quite subjective if your product could fit into multiple categories when you're importing it, in this instance, into the US, into the UK as well. The same codes will apply. You need to make sure that you're in that right category as well, because, for example, in the US, where they have the Trump tariff, you could find that your tax that you're paying goes up from 3% up to 28% quite easily if you're in the wrong category. So really focus on these things, start thinking about it way ahead of due diligence before you encounter these buyers, and really just, the most important thing is focus on that profitability of your business and make sure everything's in order. Thank you.
Matt, thank you very much. And thank you for Titan for becoming a partner sponsor of the webinar series. And we look forward to working with you going forward. Great. Okay, we have the last external speaker. I welcome Mark Rosenberg from Tartar Krinsky and Drogon to the floor. Over to you, Mark.
Thank you, Emmett, and it's great to be here. I'm Mark Rosenberg. I'm a partner in my firm's Tartar Krinsky and Drogon's intellectual property group, and I'm a founder of our online practice group. We are a full-service firm based in New York City. I think we might be the only full-service firm in the United States that has a dedicated online practice group. And in that group, we focus on IP, M&A, and really the day-to-day Amazon nonsense that affects all Amazon sellers. We represent, and in transactions, we represent both e-commerce sellers and aggregators as well. So next slide, please. So I'm going to focus on the legal end on how to stay out of problems with due diligence, intellectual property issues, corporate issues, and business issues. And I'm not really going to touch on the business issues because that was already covered. And because I'm an intellectual property attorney by background, I'm really going to focus on that today. Next slide. So what we tell clients who want to enter the exit process is the first thing you need to do is clean up your IP. Because more often than not, their IP is a mess. That's a legal term. E-commerce sellers need to resolve all their issues regarding the ownership of their IP, the inventorship of their patents, and the authorship of any work that can be considered copyrightable. If those disputes are not resolved, you're not going to get through the due diligence process. It's just going to end. So, and then there's another issue with ownership, and this is really not a due diligence issue. It's more of a corporate issue, is that sometimes this is, and it's a tax issue. So sometimes the IP is owned by the company that's being acquired, the e-commerce seller, and sometimes it's owned by one or more of the principals, which is totally fine and is not a red flag until this becomes an issue when the transaction is ready to close. And sometimes the purchaser, the acquiring company, will ask that all IP be transferred to the target company, the e-commerce seller. And other times it doesn't care, that there'll be a transfer of the IP from the owner, the company, as well as the principal. The problem becomes, is there tax implications for all of this for the principal? And to wait to the last minute to figure it out becomes a problem. And more than once, I've had clients come to me and say, what should I do? And my response is, you really need to talk to your CPA because there's serious tax issues. I get a call back, my accountant's on vacation. You can't wait to the last moment for this. So that's something to really be aware of, is how do you want to, for tax purposes, who do you want to own the IP before the transaction process even starts? Then with contractors, companies all the time hire contractors to create photographs, artwork, product designs, products, software, what have you. Under United States law, unless the contractor contract with the contractor specifically says that the e-commerce company owns the IP or what's been created, that is owned by the contractor. And at most, what the e-commerce company has is a license. Well, that license may not be transferable, or an acquiring company may not want a license. It's buying the e-commerce company for its product designs, for its software, for the artwork it uses on its products. And if it doesn't own it, that deal is dead. What I see too often is e-commerce companies then run back to the contractor during the due diligence process saying, I need you to assign the IP to me. Sometimes that's not an issue because sometimes the contractor itself meant to assign it to the e-commerce company, but other times the answer is no. Or, okay, fine, but pay me a lot of money, much more than the IP is even worth. And that right there can kill a deal. So, that's something to think about well in advance. And particularly when you tell the contractor you're in a rush, of course, the contractor may want to charge more money for the IP. Then inventorship. This is a patent issue. Typically, what you need to have is in a typical situation, an inventor, an individual invents it, comes up with an invention, and then assigns the invention to the applicant, which is typically a company, who then proceeds with the patent process. What happens when you're dealing with smaller companies, when I mean smaller in terms of just number of people, is that the invention is created by either one of the principals or a key employee, and no one thinks about getting a written assignment, that the entity just goes ahead and files for a patent application. Well, come to the time for due diligence, the acquiring company is going to want to see a clean chain of title from the inventor to the target company. And that's easy to fix when the inventor is still with the company. It's not so easy is when the inventor has left the company, particularly on bad terms, and doesn't want anything to do with the company, the target company. So that needs to be taken care of well in advance of the due diligence process. Yes, there are ways of fixing it, but they're not going to be fixed within 2 weeks. It can take months and petitions being filed with the United States Patent and Trademark Office. And then when all assignments are done, you want them recorded with the United States Patent and Trademark Office in connection with your patent. Next slide, please. So assignments, it still goes to the ownership issue of who owns what. And for all IP, patents, trademark, copyright, you want a clean, unbroken chain of title. A break in the chain of title can put a deal in jeopardy or can drastically lower the value of the deal because there's now risk introduced into the deal as to the IP. Because what the buyer doesn't want to have is someone come out of the woodwork and say, wait a second, I never assigned, I still own the IP. I never assigned it. And that's that going back to the patent issue, that's the concern with when there's no assignment from the inventor, that you don't want an inventor coming out of the woodwork after the transaction closes and saying, that's my IP, that's my patent. There was never a right for the target company to file a patent on it in the first place. And then record all assignments in the United States Patent and Trademark Office. It becomes public record and it becomes largely indisputable. Now with trademarks, that was touched upon by Matt, you want to register them in the United States with the United States Patent and Trademark Office and around the world with the home country. And I cannot emphasize more, register all your key trademarks in the country of manufacture, particularly China, because of the bad faith there, the bad faith filings that can prevent your product from being manufactured or exported in China. It's really, really important. Registration process in the United States takes now over a year. So this is something you cannot wait to the last minute to think about. And then if you have to wait to the last minute, at least get some applications on file with the United States Patent and Trademark Office. Don't just have common law trademarks. That common law trademarks in the United States, yes, you have most of the rights of a registered mark, but you don't have all. And registered rights, a registered trademark is worth more. It increases your valuation. Next slide, please. With copyrights, again, in the United States, you do not need a copyright registration to make to have a copyright. However, for valuation purposes, you want your copyright, important designs and images registered. That way, there's no dispute of whether or not you own a copyright on it. Very good, it's very important. Then for infringement, again, keep in mind, you want to clean up all the infringement on the key platforms, particularly Amazon. And Amazon makes it relatively easy to get infringers off the site. If you have a registered trademark, if you have a patent. If you don't, it's much harder. And of course, you want to clean up all the infringement issues made against the entity, because acquiring companies are not going to want to buy into a potential lawsuit. Or if they're going to buy a company that has potential infringement risk, the valuation is going to be down, be lower. Next slide, please. Then the corporate issues, what I mean here is really corporate structure. Who owns what among the actual individuals who own the company? Lots of times, 2 friends form a company by using a template document on LegalZoom, which is great for running a company that everybody agrees on everything. But often these formation documents don't have provisions for what happens. Let's say you have multiple owners, one or two don't agree. Then what? There's no provision that covers that. The documents don't have, what happens in the disposition of all or some of the assets of the company. Again, you want to deal with that long before you start getting ready to exit. If you start waiting to the time to exit, you may delay everything. Also, structuring your corporation so to lessen the tax implications of any sale of the business or asset. Again, this takes time. And that's what I cannot emphasize more is really start early with getting ready for due diligence issues and cleaning up your IP and cleaning up your corporate issues. This can take over a year, and too often the client doesn't come to me until just about the time they're about to sign they've signed the LOI, or they want us to read the LOI once to say if it's okay to sign. By then, it's really too late to clean up most of these issues. And so I cannot emphasize more, start at least a year in advance to get your company ready for it to be exited. Thank you.
Thank you, Mark. Very good. Lots of good data points there. I didn't realize it took a full year for registration. It just shows you that timing and planning is key, which is a nice segue. Your last slide, plan in advance, which I totally agree with, and is a great segue to this section 2, where I'll just spend 2 minutes talking about becoming exit ready. It's a key part of what we do here at the Fortia Group, and then we will have a few minutes left for Q&A. All of the speakers have been asked to summarize the key single takeaway that they have for sellers when it comes to thinking about red flags and due diligence. So we'll get to that in 2 minutes. Okay, so preparation is key. It sounds obvious, but I worked at Morgan Stanley, big M&A deals on both sides of the Atlantic. When people are planning for it, it happens 1, 2, 3 years out. It does not happen in weeks or low number of months. The best deals require a huge amount of planning if you really want to get the best valuation, the best terms. So failing to prepare is preparing to fail. We often ask the question to sellers directly, how much time have you actually spent planning your exit? And I think DTC entrepreneurs spend more time because there's more of an org structure and so on, and they've raised capital, so they often have external investors. But certainly for Amazon FBA businesses, sometimes it can be days or weeks. Maybe this time last year when LOIs were being handed out within 48 hours, it was days. But please, entrepreneurs on the call and listening to the recording over the coming months and years, please prepare as early as you can. In our view, that should be at least 1 year out. We recommend 4 steps to help e-commerce entrepreneurs do that. The first is we have the best exit guide in the business for Amazon FBAs. It's 90 pages. It's available for free from our website. And we are currently drafting a similar guide for DTC, sort of Shopify type entrepreneurs. That's being published in 3 months' time. So please look out for that. The second is create a bespoke exit ready program. The guys at Titan do that. We absolutely do it. We have currently 11 clients that are in our exit ready program. And I'll go into that in a bit more detail in a moment. The third is get a really strong suite of advisors, whether it's accounting, legal, you've heard from Mark, you've heard from Nathan, product quality control, you've heard from the guys earlier on at Factory. That's really key. You need the best advisors. If you want the best deal, hire the best people. Sounds obvious, but a lot of people don't even hire advisors or don't upgrade advisors. And then a big one for me, I used to do this when I worked in investment banking, is rather than just waiting to start a process in 3 months' time or 9 months' time and only interacting with buyers, then start speaking with buyers soon in a coordinated, thoughtful fashion. We call it pre-marketing, because we're big believers in that whole concept of flirt, date, marry. It's better to warm up and find which type of buyers are most interested. Is it aggregators? Is it private equity firms? Is it corporates? Is it all three? And get feedback from these folks, really smart folks, a lot of them on the call today, a lot of them listening. Ask them what could you do better to improve your business. So that's a really important thing, and frankly, very few e-commerce entrepreneurs do that. And frankly, very few entrepreneurs looking for an exit do it, let alone e-commerce. So what do we mean by an exit ready program? We create bespoke programs for all our clients across 3 work streams, which marry up to the 3 co-founders of the Fortia group. So I provide the strategic advice. I'm ex-investment banker with Morgan Stanley, one of the best M&A firms in the world, if not the best, and Credit Suisse, a preeminent investment bank. I help our client think about strategy, the strategic options. Should you acquire another brand before an exit? Think about financing, whether it's revenue-based financing, inventory financing, and so forth, to help you grow. From a financial perspective, my colleague David is a qualified accountant, CFO, and he helps all our clients think about prepping their financials so that they're shown in the best light possible. A lot of the comments of the speakers today resonate with the work we do there. So we rebuild the P&L, we make sure that it's transparent, it's clear, that there's no funnies, and it'll be welcomed by buyers when they ultimately get access to it. And then operational, we're one of the few corporate finance firms in the world that has operational expertise. Paul worked for an Amazon agency, but also for Water Wipes, one of the leading baby wipe companies in the world, a huge business, and he helps understand the operational side, what improvements can be made during the exit ready journey, and of course getting feedback from the buyers and implementing those on the operational side. So we'd love to speak to more e-commerce entrepreneurs that want to join us in due course for an exit, but focus today on creating a bespoke program to get there. Okay, so section 3, we have 6 minutes left. I'm going to ask all of the speakers to turn on their cameras, and I'll ask each of you to give us your key takeaway from today. What's the one thing that you think sellers should take away from today? And we'll start with Thomas, and then I'll ask others to put their hand up. Thomas, over to you.
Thank you very much. Number one thing from our perspective is come to the process with transparency. So whatever issue you may think that you have in the business, put your cards on the table. We can assess it together. It'll be entirely collaborative. We always find that we can typically work through issues with prospective sellers. If you come with issues and hide them or kind of partially reveal them over time, it will get found out. It will destroy trust in the process, and it could hurt your prospects of closing a deal with us.
Very good, Thomas. Thanks for leading. Mark?
It's a combination of what everyone has said here. It's really one, the transparency. You know, as an attorney, if I don't get the client's information, I can't give good advice. If you give me part of the facts, I can't really help you because I'm giving half the book. And the other thing that's clear that almost every presentation is how much time this takes. Don't wait for the last minute. To have it come up in due diligence, have issues come up in due diligence, often is too late to fix them.
Mm-hmm. Thank you, Mark. Nate?
Yeah, I mean, similar to what others are saying, would say start the process early and, be totally transparent. If there's skeletons, in the closet or did things wrong, it's going to come out later. Mm-hmm. And so better to be upfront about things so that they don't end up killing a deal, as opposed to trying to hide it and then it finding out and the buyer losing trust. And yeah, just starting the process early. It's a lot. So better to start it early.
Great. Thank you, Nate. Adar?
Yeah, following on what Mark mentioned, from my perspective, is obviously run quality control on your suppliers and products. I think it will significantly increase your valuation of the sale. In general, even if there's no sale, it will give you a lot of better visibility into the performance of your suppliers, help you solve problems before they occur, and obviously reduce those costs that follow that.
Yeah, fully agree and endorse that. Nathan, please.
Yeah, don't let diligence overwhelm you. It's a time-consuming process. Build out a team internally and externally, and make sure you can get through inquiries quickly and accurately. Because the main thing is during the diligence process is to not let it affect brand performance during the process, because that could have even bigger issues.
Yeah, agreed. Thank you, Nathan. Matt?
Yeah, I think, from the seller's point of view, as you're rapidly growing and scaling your business and trying to get your EBITDA as high as possible, don't lack on the business side of things. The drier subjects that we've talked about tonight: know your numbers, know your profit margins, track them, don't leave any surprises down the road, and keep your business clean and compliance, legal, and all of those other areas. Because it can sure be stressful in due diligence when surprises pop up when you think you're a week away from your deal. So do the work now and get your business in shape.
Great. Thank you, Matt. Carlos?
This is not the time to be penny-wise. So arm yourself with the best team possible around you. You do not have to be an expert in every single facet of a transaction, whether it be financial, legal, or accounting. So, it's what you don't know that can kill you, right? So make sure that wherever those blind spots that you have in a process, that you fill them with the right teammate to have a successful transaction.
Agreed, Carlos. Thank you. And to finish, Simon.
Yeah, just echoing what Matt was saying, absolutely focus on trying to get your business in great shape. Everybody leaves money on the table at the moment with not being tough enough on their service providers. There's plenty that you can do to improve your EBITDA margin. And then secondly, just be data ready. So have all your data in great shape, ready to share with potential buyers in minutes, and don't delay in that process.
Thank you, Simon. Thank you to all the speakers today. Just one more slide from me to give you all a heads up on our next webinar, which is on October 20th. It'll be specifically about how private equity firms value businesses. This was also one of the most requested topics when we surveyed our clients at the last webinar. So with that, I'd like to again thank you all the panelists for participating today, for the great content. It was action-packed. There's lots in there. There's lots to digest. Again, the recording's available for those that need to go over it again to digest it. And I wish you all a great day. Thank you.
Thanks, Anna.